Joining me now is Bill Adams. He's the chief economist at Commercia Bank. Welcome to the show.
Good morning, Ashley. Thanks for having me on.
So what storyline are you monitoring most closely this week?
For macroeconomists, there hasn't been as much data as usual with the government shutdown, and so the CPI report later this week is going to be the big focus. I'm expecting it to show prices up a little more than 3% year over year on a core basis, so still running above the Fed's target.
All right, and last week, Fed Chair Jerome Powell signaled that the central bank would likely end the runoff on the balance sheet in the coming months. What does this mean for investors?
The runoff of the balance sheet translates into slightly higher market rates. So if you look at the secured overnight funding rate, or SOFR, relative to Fed funds, we've seen a premium open up on that in the last couple of months. And that is one of the signs that money market conditions are tightening. And that's been part of the Fed's goal with reducing the size of their balance sheet to reduce an element of supply and demand, cost of funds in short-term money markets. So I think the end of balance sheet runoff is likely to lead to a stabilization of those money market conditions. Net, I think that's favorable for riskier asset classes as well.
All right, and according to the latest data, we're seeing that over 95% of traders are anticipating that we're going to see 2 more rate cuts this year. In your view, what does this timeline look like entering 2026, and how many cuts can we see in the new year?
I think we will likely see those 2 cuts through the turn of the year because the Fed is concerned about signs of slack in the job market. Economic growth has been solid this year, but very uneven, very overweight on AI investment in data centers, investment in computing equipment, not as much in more industries that create more job growth. So the Fed wants to stimulate those or take their foot off the brake, at least, for the industries that drive most employment in the U.S. Into the new year, I think we could see the Fed go on pause for a couple of months, but Chair Jerome Powell's term will end in May. I think after that, we're likely to see a new Fed chair who will nudge the Fed towards additional rate cuts in the second half.
All right, and despite the government shutdown, this September Consumer Price Index is going to come out on Friday. What are you anticipating from that?
That CPI report is importantly going to be the benchmark for the Social Security cost of living adjustment in 2026. I think seniors are likely to see their Social Security payments go up by close to 3% next year. So that'll be a nice bump for retirees' incomes. We're also going to see a boost in retiree incomes from the increased deduction for tax filers over 65. And that should fuel more consumer spending from older Americans in the new year, and I think a broadening of economic growth in 2020.
And do you think that the Fed is going to put added weight into this report due to the lack of other hard data like jobs or wholesale prices?
With the paucity of those other data, the Fed is looking, like other economists are looking, at private sources of data. We've had a number of estimates of job growth for the month of September from Revelio, from LinkedIn, and they range from a modest monthly decline to a modest monthly increase, but still looks like the job market is holding in low fire, but low gear. And with that, I think the Fed feels like they have, a hazy view, but enough of a view that probably still makes sense to cut interest rates slowly.
All right, and we're still fairly early into earnings seasons, but what do some of the major themes say about the state of the economy?
The economy, again, is in low gear, but it is growing. It doesn't look like the economy is in recession, and I think we're likely to see economic growth downshift a little bit into Q4. We had a big boost to growth in the third quarter from consumers going out and buying EVs before those EV tax credits expired. And we're going to see some give back from that near term. But again, into 2026 with lower interest rates and with a more expansionary fiscal policy, I think we should growth reaccelerate.
All right, and what other economic storylines should investors and our viewers be tracking in the coming days?
It's a cliche at this point, but I think all eyes are still on AI adoption. And at what point does spread of AI through the economy turn into productivity gain? Productivity is output per hour worked, and getting more out of the same amount of workers in a business and the same amount of capital. And with this technological change, it seems like we should see productivity accelerate. And that could be a big boost to economic growth and to earnings growth for the next couple of years.
All right, and what do investors need to know about the economy right now?
I think the big question in the economy right now is what don't we know that we don't know? With the limited economic data, it's possible that we could be experiencing a turning point. That's not our base case, but I think that is a risk. The high frequency estimates that we have, again, are that we saw decent spending growth in September, but we don't have much information yet for October. We have less than we usually would because we're not getting those weekly releases of unemployment insurance claims.
And what do you think the Fed might do in 2026?
I think the direction for the Fed is continue to reduce interest rates slowly. The Fed has told us that they want to move rates closer to neutral. Neutral is, it's not a number, it's an idea that rates are not an impediment to growth, although not a boost to growth. And Fed policymakers think that is somewhere around 3%. So that's another couple of rate cuts beyond where Fed policymakers are telling us to expect rates to be at the end of this year.
All right, thank you. Bill Adams, Chief Economist at Comerica Bank.
Thanks, Ashley. Congrats again to Kevin.
Thank you. Coming up, our next guest says